You're scrolling through real estate listings at midnight, and every single house that doesn't look like it's about to collapse costs $500,000. The kitchen has laminate countertops from 2003. The carpet is beige. There's fake wood paneling in the basement, and the listing agent has the audacity to call it a starter home. Meanwhile, you're sitting there doing mental math on your salary, wondering if you've somehow missed a massive promotion or if the entire housing market has collectively lost its mind. Spoiler alert, it's not you, it's the math, and the math is absolutely brutal. Today we're going to do something that real estate agents hate. We're going to calculate who can actually afford a $500,000 house in 2026. Not who the bank will give a loan to, but who can legitimately afford it without turning their life into a financial stress simulator. Because there's a massive difference between qualifying for a mortgage and actually being able to sleep at night after you sign the paperwork. In dozens of U.S. markets right now, $500,000 is the baseline. That's not getting you a mansion. That's getting you a 1,200 square foot box with 3 bedrooms, 2 bathrooms, and a yard the size of a beach towel. In cities like Denver or anything within commuting distance of a major metro, $500,000 is what normal people are expected to somehow come up with for normal houses. The median household income in America is around $84,000, so we're asking people making $84,000 a year to afford homes that cost 6 times their annual income. If that ratio sounds insane to you, congratulations, you're paying attention. The traditional rule was 20% down on a $500,000 house. That's $100,000 cash. The median savings account in America has around $8,000 in it. So you're not just a little short, you're $92,000 short. And before you say you'll just save it, here's that math too. If you're making $84,000 a year and somehow manage to save 10% of your gross income, which almost nobody does, you're saving $8,400 per year. At that rate, it'll take you 12 years to save the down payment, assuming housing prices don't go up, which they absolutely will. So you skip the 20% down payment, you put down 5% or 10% instead, which is what most people actually do. Congratulations, you just unlocked a new expense called PMI, Private Mortgage Insurance. This is the fee you pay every single month for the crime of not being wealthy enough to put 20% down. It runs anywhere from $200 to $400 per month, depending on your loan. You're paying extra money every month for insurance that protects the bank, not you. You're already starting from a position of financial punishment. You put down 10%, which is $50,000. That leaves you with a $450,000 loan. At current interest rates, somewhere in the 6% to 7% range, your monthly mortgage payment lands around $2,750 to $2,850. That's just principal and interest. That number doesn't include a single other thing you need to actually live in the house. Add property taxes. Depending on where you live, you're looking at $4,000 to $8,000 per year, roughly $500 per month being conservative. Then homeowners insurance, which has skyrocketed thanks to climate change making everything more expensive to insure, another $250 to $350 per month. Then maintenance, the thing everyone forgets about until the water heater explodes at 11 p.m. on a Sunday. The standard rule is 1% of your home's value per year. On a $500,000 house, that's $5,000 annually, or about $417 per month. Add PMI on top of that at another $200 to $400. Total monthly housing cost, roughly $4,367. And that's assuming nothing breaks. No new roof, no HOA assessment, no emergency. Financial advisors say you shouldn't spend more than 28% of your gross monthly income on housing. Banks will approve you if your total debt-to-income ratio is under 43%. Let's reverse engineer this. If you're spending $4,367 per month on housing, and that represents 28% of your income, you need to be making roughly $187,000 per year. If we use the more lenient 43% rule, you still need to be pulling in around $150,000 annually. Only about 10 to 20% of U.S. households make $150,000 or more, which means 80% of American households cannot comfortably afford a $500,000 house under any reasonable financial standard. This isn't an opinion, this is just math being cruel. Consider a household of 2 working professionals pulling in a combined $160,000 a year. That puts them well above the median, solidly upper middle class. They should be comfortable, right? Their gross income of $160,000 sounds impressive until taxes show up. After federal taxes, state taxes, FICA, and a modest 401k contribution, they're taking home around $9,500 per month. Subtract that $4,367 monthly housing cost, and they're left with $5,133 for literally everything else. 2 car payments are $800. Car insurance for 2 vehicles is $250. Gas is $300. Student loans is $600. Health insurance premiums not fully covered by employers are $400. Groceries for a family eating reasonably healthy is $800. Utilities, electricity, water, gas, internet, phones are $450. That leaves $1,533, and we haven't touched clothing, entertainment, kids' activities, car repairs, medical copays, or the basic human need to occasionally leave the house and pretend you have a life. Savings and retirement beyond that modest 401k contribution, good luck. This household is spending 46% of their take-home pay on housing, not 28%, not even 35%, nearly half. And these aren't irresponsible people. They're not buying jet skis or taking European vacations. They're just trying to live in a house the market tells them is normal. Here's what that actually feels like day to day. It feels like checking your bank account before buying groceries. It feels like saying no to your kid's field trip because that $35 might be needed if the check engine light comes on. It feels like lying awake at 2 a.m. doing mental math about whether you can afford new tires this month or push it to next month and just pray. It feels like being one unexpected expense away from disaster at all times. Month 1 after buying, you make the payment. It's tight, but you did it. Month 4, your car needs new brakes. $800 you didn't budget for because every dollar is already allocated. You put it on a credit card. Month 7, the air conditioning dies. In July, the repair quote is $3,500. You finance it. Month 9, one income gets reduced. Now you're $600 short every month. And that emergency fund you were supposed to build? It never happened because there was nothing left to save. This is being house poor. You technically own a house, though the bank really owns it for the next 30 years, but you can't afford to live in it comfortably. You can't afford to maintain it properly. You definitely can't afford to enjoy it. Every unexpected expense becomes a crisis. Every financial decision runs through one filter. Can we still make the mortgage? Because housing has become so unaffordable, we've normalized this misery. We've rebranded financial desperation as adulting. Can't afford furniture for 3 of your rooms? That's just part of the journey. Eating on a tight budget because all your money went to the mortgage? You're building equity. We've collectively agreed to pretend that struggling to afford basic ownership is a rite of passage rather than a symptom of a broken system. The math is screaming at you, but culture keeps whispering that you should buy anyway. Your parents bought a house at your age, never mind that their house cost 3 times their annual income, and yours costs 6 times yours. Society tells you renting is throwing money away, never mind that being unable to afford your mortgage is also throwing money away, just with worse consequences. House prices have increased roughly 400% since 1990. Median household income is up roughly 180% in the same period. The math doesn't work. It cannot work. It will not work. And yet we keep pretending it does. You can't budget your way out of a structural affordability crisis. You can't side hustle your way into a down payment when rent is eating 40% of your income. What you can do is understand the actual numbers and make an informed decision. Maybe that means continuing to rent and investing the difference. Maybe it means looking at a $350,000 house, even if it means a longer commute. Maybe it means acknowledging that home ownership in your current market simply isn't viable right now, and that's okay. There is no prize for buying a house you can't afford. There is no trophy for being house poor. The stress of barely making your mortgage payment every month will erase any pride you felt the day you got the keys. If you're looking at a $500,000 house and your household income is anywhere south of $140,000, run the real numbers, all of them. The bank's risk tolerance and your ability to actually live a life are not the same calculation. Nobody in the transaction, not the mortgage broker, not the real estate agent, not the lender, has an incentive to tell you that you're about to financially drown yourself. The system is designed to get you into the house, not to ensure you can comfortably afford it long term. Real wealth isn't owning a house you can barely afford. It's having margin in your budget. It's being able to invest consistently. It's not having to choose between fixing your roof and contributing to your retirement. It's sleeping at night without anxiety about next month's payment. Real wealth is freedom, not equity you can't access because you're trapped by the asset that's supposed to be making you wealthy. Stop looking at what you qualify for and start looking at what you can genuinely afford without turning your life into a financial tightrope act. Find the number where you can pay the mortgage, handle the maintenance, save for emergencies, invest for retirement, and still occasionally remember what it feels like to not be stressed about money. For most people, that number is nowhere near $500,000. And that's not a failure. That's just math, the honest kind that nobody else wants to do for you.